Welcome back to The Responsibility of Investing, the podcast from the Principles for Responsible Investment, where we explore how investors are putting responsible investment into practice. Before we start with the questions, it would be good to get some context about the instruments that we're talking about, so a little bit of blurb up front from me. Today, we're looking at responsible investment in securitized debt securities. Securitized debt instruments sit at the heart of the global securitized debt market, roughly a $14 trillion market and a meaningful slice of many core bond indices and fixed income portfolios. Unlike traditional corporate bonds, securitized debt gives investors exposure to pools of underlying loans. For example, thousands of individual home mortgages or commercial property loans are bundled into tradable securities. This pooling structure can channel capital that might otherwise struggle to access institutional funding, such as energy-efficient homes, climate-resistant buildings, or affordable housing for underserved communities. We're also seeing securitization move into newer parts of the real economy, for example, data centers. I'm joined by two guests who contributed to the work behind the Technical Guide to Responsible Investment in Securitized Debt, which was published last year, available to our signatories on the MyPRI website. We're very thankful to that working group for inputting into our guidance process. So before we dive into more detail, can you give our listeners a bit of the lay of the land? Why does securitized debt matter from a responsible investing perspective?
So securitization markets are a big part of how we fund, and Kate, you used this word, which I appreciate, how we fund the real economy, whether we're talking about this through the consumer lens and thinking about things like student debt or credit cards or auto loans or leases or real assets. And in kind of the most classic way, we can think about this in terms of homes or commercial properties through the mortgage-backed security market. And while this part of the market really touches all of us, the asset class actually seems pretty abstract to most people. But again, it is part of the market that really directly touches all of us in our daily lives. But when you think about this through the RI or the ESG lens, what's clear is that it's probably, I would say, the last part of at least the public fixed income market where we've really sort of dove into how to think about ESG factors from a systematic way, and how we think about generating impact through our investments. And so I think it's pretty poorly understood how to integrate ESG into securitized markets, which in my view creates both blind spots, but also exciting new opportunities for us and for our investors. And so, when the opportunity came about to be part of the PRI's work when it came to sustainable securitized and to ultimately work on this technical guide, I jumped on it because I think there's a lot of scope for innovation.
That's so good. Malea.
No one is talking about securitized. At TCW, at the time, almost half of our assets under management were in securitized products. And we were starting to get client requests coming in for our securitized mandates asking about ESG integration. And so we kind of just, picked up the torch and started to dig into this asset class. There wasn't any data. There wasn't coverage. We saw some labeled bond issuance coming out of the US from the government-sponsored enterprises, but it was really slow uptick. There wasn't a lot available. And so what we did was, we kind of thought, why is securitized getting left out of the conversation, right? And so what we wanted to do is look through to the underlying collateral and look for those green or social characteristics. Affordable housing is a really tangible example. Energy efficient commercial real estate is another tangible example. And we were already seeing that data coming to market. There just wasn't a third party that was collecting it. And so you really have to be proactive in your bottom-up credit work and target collateral that have these environmental or social characteristics. And so that's really where we started. We actually launched a fund in 2021 as kind of a flag in the sand to show the market that sustainable security selection in securitized products was possible. You just have to look outside of, the labeled bond space, which was your ICMA aligned bonds, the second party opinions, and look through to the underlying collateral. And we found that we could still, create this mandate, invest sustainably, and still generate strong risk adjusted returns.
I'll add what's interesting about this space is that while it was really the last part of the public fixed income market to think about ESG, either from the risk integration or the impact investing lens, ESG risks are really a core part of what this market is. And because we're talking about the consumer and we're talking about real assets, uh, think about what the major risks are. Predatory lending, aggressive loan servicing. These create real credit risk. And if you talk to any credit analyst in this space, they are thinking about that. Similar on the real asset side. If you have a home or a commercial building, what are the main risks to it? It's going to get destroyed through an acute climate event.
Yeah, it's absolutely fascinating about how you talk about loans and literally the consumer, literally the individual, right at the heart of it, and enabling us to bring them forward into responsible investing in somewhere. That's really cool. So let's jump to the next question. How do you practically embed ESG factors into your securitized debt analysis? Could you give us a bit of an overview on the types of instruments that you cover, and maybe a bit more color on residential and commercial mortgage-backed securities analysis, and what does the process look like?
We first have to take kind of a top-down, high-level approach here and think about why are we even looking at ESG factors in the first place. And I think in order to do that, we have to separate out what I've referred to previously as ESG risk and impact here. And when I talk about these things, they're really two sides of the spectrum. Now, when I refer to ESG risk, what I'm talking about is how environmental, social, and governance risks impact the securitizations that we're investing in. And so these are credit material or financially material factors. And when I'm talking about impact, I'm talking about how the securitizations that we're investing in impact the environment and society, really irrespective of any financial materiality. So it's kind of the opposite flow or the opposite direction of materiality. Now, at a very basic level, as a fiduciary, ESG risks are credit risks. So they really are no different from any other credit risks that we're looking at. These are a normal part of our bottom up credit research process. We integrate them into our credit rating process the same way that we would any other credit risks. And so when it comes to things like security selection and portfolio management, they're simply built into our relative value assessment, again, the same way that anything else is. And this is done for every investment we make, for every strategy that we manage. Now, when it comes to the impact factors, because these aren't necessarily financially material, we only apply these when we have mandates which have an explicit target or goal of applying an impact overlay, where clients have that impact preference. And so for us at PGIM Public and Private Fixed Income, we've actually developed our own proprietary impact rating system where we look across the issuer, the collateral, and the use of proceeds when there is more of a labeled securitization type of tool. And we will rate each securitization on this scale, which we'll then use to determine eligibility for those more impact forward strategies. But again, that's only for those strategies where the client gives us a specific mandate to do so. Again, just to recap at a very basic level, when we talk about RI or ESG, the industry kind of does itself a disservice by calling everything the same thing. But in reality, you have to distinguish between ESG risk and impact.
That was really well put around the risk and impact. Thank you. Malea.
At TCW, we always say that ESG is just good risk management. And I think that, incorporating ESG risk and opportunity factors into the credit underwriting process has always been something that's been done on the securitized desk, looking for environmental components in CMBS, right? We can think about a commercial property with a green building certification. And this is a really good example where I think credit fundamentals align with sustainability because you have property sponsors that have their own sustainable targets or emissions targets that they have to meet. And so a percentage or a growing percentage of their commercial portfolio is now LEED certified or has some sort of green building certification. And what we see with some of those properties is that the tenants tend to be stickier. The rent rolls seem to be longer. They can charge higher rents. And you also have things like sustainable features of the property helping to lower the operating costs and improve NOI, net operating income. So you have these credit features that when you align them with sustainability, kind of already make for a suitable investment for a sustainable or a non-sustainable portfolio. And I think that this is what we really apply when we're thinking about security selection, particularly in the commercial space, because it is a bit more tangible. But what we're also seeing in the residential space is things like affordability metrics. And, we can kind of talk about how some of the more credit impaired borrowers are seen aligning with the social housing component of ESG, but we don't always see bad credits in affordable housing. We do have sustainable portfolios that we have mandated that we do need to target a certain percentage of high quality sustainable assets, but we're relative value investors first and foremost. So we're never going to sacrifice returns for sustainability. But what we found just over the years of allocating to sustainable portfolios and expanding security selection is that we don't have to give up returns for sustainability. I think that that's a really important thing for the market to understand.
So we all love a case study. We all love an example. So could you think about a couple of examples that might really bring this to life for our audience a little bit?
Kate, you had mentioned early on data centers, and obviously that's a hot topic now. And in the securitization market, this is probably one of the fastest growing areas when it comes to CMBS or also ABS. And what we see when it comes to data center funding is that a sizable share of data center funding is being done through either an asset-backed security structure or a commercial mortgage-backed security structure. And at a very sort of simplistic level, what that means is when a data center developer builds a data center and they lease that property out to a tenant, they will take those cash flows, the future cash flows from that lease agreement, they'll bundle them, they'll securitize them, and then they'll sell those to us as investors for upfront cash or capital, which they can then free up balance sheet space and use that for, let's just say, again, simplistically, for their next data center development. Now, we recently funded a private asset-based finance deal, a data center deal, where the tenant was a highly rated tech firm. The lease payments were guaranteed by this tech firm, so essentially the credit risk was the credit risk of the tech firm. Now, according to the stipulations of the lease agreement and the terms of the deal, the only way that the tenant could essentially break that lease is if the data center property went offline for 24 months, I believe it was. And when you think about what could bring a data center offline for that long in the post-construction phase, so after it was already built, really the only way this could happen is if there was a major catastrophic event. And you can think of this through the lens of a major weather event that would completely knock this property offline, and the data center developer wasn't able to rebuild it or to repair it. So of course this had us worried about what could this look like, and would the data center developer be able to rebuild? And what that led us to is, okay, well, what is the insurance coverage for that? Because if this happened, do they have the insurance coverage to recoup those costs and repair it? And what we found is that the insurance coverage was priced for a 1 in 10,000 year weather event. And the size of that coverage was less than the replacement cost of that property, which at the end of the day was the size of the financing for that property. And so in the event that there was a major, let's just say flooding or storm or whatever it might be that destroyed the entire data center, the insurance coverage was not going to be enough to cover the total cost of repair. So obviously that presents a credit risk. And so what we ended up doing was we notched our internal credit rating down. Now we still ended up participating in this deal because we still felt that the risk was properly priced into the deal. And at the end of the day, none of us are in the business of avoiding ESG risks. We're in the business of ensuring that we are properly compensated for those risks. But I think what this example shows is that this is a case where an ESG risk, in this case an environmental risk, was not just sort of an ancillary risk. This was kind of the core risk to this deal, which factored directly into our credit rating.
Because of the way that the world is adapting, they are fundamental now to how these deals are put together.
And I think it's such a great example because you're really actually digging in here and thinking about how something like a climate event could really impact the credit of the underlying credit of the asset and ability to pay back the debt. And so kind of looking through into all of these nuances, again, is just part of good risk management. I do like the example that David brought up. I think it's a good way to kind of tie the public and private markets together, especially just as we're seeing so much more deal flow in private credit and into the private asset-backed finance space. Being able to really work with the issuer, work with the arranging bank on these deals early is very different than what we get to do in the public markets, where the deals have really already come to market and you're really doing the credit underwriting after the fact. But in the private space, you kind of do get that first look ability, and you have a bit more say in the dynamic and the structure of the deal. And I think now it's just important to call out some of the private opportunities that we're seeing. And I think that we'll see some of that deal flow bleed into the public space as well. So working with some of these private issuers early on to get access to more, environmental or social data, I'm hoping that we do kind of see some of that trajectory then evolve into better data and accessibility on the public side as well. And I realized that that the question was also in ESG considerations that impacted an investment. And so, like I said, I think that David had a really good example. One thing that I think is important to call out as we're talking about purely responsible investment, and we've talked a lot about labeled bonds, is that I think we learned very early on that not all labeled bonds are created equal, meaning that you do have some low quality labeled securitized bonds out there. And so, when we're thinking about allocating to any of our sustainable portfolios, for example, we do have a Article 8 global securitized usage portfolio that requires us to maintain a minimum threshold of high quality sustainable investments. We also had to set up some guardrails in place for that fund and for our other sustainable funds that restricted our traders from allocating those low quality labeled bonds, because we actually classified those as greenwashing, where we did not feel comfortable holding a labeled bond where the issuer had detailed the use of proceeds that we did not either believe were environmental or social, or weren't actually following through on what they had outlined in the framework.
So how is the availability of ESG data evolving in this market? Where are the gaps? For example, with generative AI, power usage, efficiency, grid mix, environmental impacts, they're all kind of data prompts that come to mind when you're assessing a data center. Are these transition risks, or are we just simply rebadging data? What's your thoughts?
I think one thing about our market, the securitized market, it is incredibly dynamic. It's always evolving. It's always changing. We're constantly seeing new assets being securitized. Really anything with a stable and reliable cash flow could, in theory, be securitized. And so you do have these new asset types coming online, particularly in the digital infrastructure space. On the data center side, I think it's really interesting because over the last few years, we've seen issuance in data centers just boom. And so last year, 2024, issuance in data centers was around 25 billion. The expectation for 2026 is for that to almost double to 50 billion. And the interesting thing with data centers is that over half of the data centers that have been securitized in either the ABS or the CMBS market, so asset-backed or commercial-backed market, have come with a green label. And I think this freaked out the market in the beginning because the question was, well, how can data centers be sustainable? They take up so much power. And so what we're looking at when we're looking at the sustainability of these data centers is typically PUE, or power usage effectiveness ratio. And that's effectively how a data center uses energy. But beyond that, we want to look at water usage. We want to look at emissions. We want to look at carbon intensity. We want to think about if the data center is powered from renewable energy sources or incorporates things like heat waste recycling. So I think there's more to sustainable data centers than, kind of just this power usage effectiveness ratio, but they have been a really large contributor to labeled securitized issuance. And so I think that also kind of ties in to the data aspect, because even with something like data centers, we're starting to see issuers provide as close to actual or estimated carbon emissions data. And this is really important when we start to get into carbon emissions accounting and reporting on financed emissions for securitized assets. Thinking about just the broader evolution of ESG data, I would say it's really been a treat to watch because I've been watching and been engaging, for the last 5+ years when, I'm looking at a pool of residential mortgages from the UK. And, all I'm seeing is kind of your normal credit fundamentals, LTV, LTR. And all of a sudden you start to see EPC data or energy performance certificates come online. And then you see more issuers providing EPC data for RMBS. Then you start to see it for CMBS coming out of UK and Europe. And it's just been really encouraging, I think, to see this evolution. And that doesn't come out of thin air. Issuers aren't waking up saying, I'm going to add EPC certificates to all of my loan tapes. No, that comes from people like myself, people like David, calling issuers and asking them for this information. And that's really how you start to see this evolution is it has to come from the capital markets, from investors, which ultimately come from our asset owners, who want sustainable portfolios, which in turn we need the data in order to make the designation if it's a sustainable security or not. We started to see labeled bonds come to market in 2012 from the government-sponsored enterprises out of the US. It really started to uptick in 2021, kind of when ESG was really having its moment, and issuance was around 160 billion. Today, global securitized labeled bond issuance is around 450 billion. And so you're seeing that growth, you're seeing volumes increase, even out of the US, which is actually responsible for the majority of labeled issuance. One of the, I think, questions that sometimes that get raised is, well, with the political climate in the US and with the pullback of the Inflation Reduction Act, Trump coming into office, how do ESG bonds fare? Where does the securitized market fit into that? And while other asset classes actually saw a pullback in their ESG labeled issuance, securitized was one of the only asset classes that saw an increase in issuance from 2024 to 2025.
David, come on. What's your perspective on the data?
Yeah, I mean, Malea's been banging the drum on this for a little bit longer than I have. So everything she said and more, I'll just point out that I've seen some exciting developments as of late as well. And I'll just point to one example here in the US, which I was pretty excited about. In the CMBS market, there was actually earlier this year a recent issuance for what's called a single asset, single borrower. So just one property in New York City where it was a green labeled deal. And it was based off the fact that the building itself was LEED certified, which is pretty standard. But this deal came with much more substantial impact reporting. And, of note to me, at least, was the fact that the impact reporting came with disclosure around reported emissions reduction from a recent switch over from number two fuel oil to biofuel, which, Malia, I don't know if you've seen anything else, but to my knowledge, that was really the first time that I've seen this type of emission reduction reporting. For me, what's exciting about this is that it represents a significant step when it comes to ESG disclosure, because what it allows me to do is to actually quantify emissions reductions in a tangible way. And so this is the type of data disclosure, the type of information I need to help meet the sustainability goals of my clients.
So let's turn to engagement in the securitized market. So just sort of almost to square the circle of all the component parts. Who are you actually engaging with, given that these instruments have different structures?
Engagement is really how we drive change in this market. And that means engaging across the ecosystem. That's public issuers, private issuers, investment banks, data providers, regulatory bodies, industry bodies, asset owners. And that's, I think, what engagement is and why engagement is such a critical part of furthering responsible investment in any asset class, but particularly in securitized credit, because you do get access to more information. And we have seen engagement really drive evolution. It's also the reason that the market will see the methodology for financed emissions calculations in securitized products. And that came from engaging directly with PCAF, the Partnership for Carbon Accounting Financials. And that was really crucial because for market participants and for asset owners that want, carbon emissions reporting for a securitized portfolio, they couldn't get that. Asset managers were saying, well, there's no methodology. We can't really provide anything. Meanwhile, we're sitting back saying, well, the built environment is responsible for 60% of global emissions. So you can't just zero that out. So what do? We engage. Engagement is important because we all have to work together towards the same goal of meeting our clients' goals.
Yeah, no, and one thing that I'll just add, one area of the market that I've been particularly focused on lately is engaging with the investment banks or the arranging banks, which is a key component of this market. And I'll say I've been thinking about this through the lens of two separate components. One is on deal structure, and the other is on data disclosure, topics that we've kind of alluded to or discussed directly as part of this conversation. Now, on the deal structured side, you can think about this through the lens of both the broadly syndicated space and also from the private space. And on the broadly syndicated space, I think the fact that the arranging banks have such a broad view of the market and talk to so many issuers means that they have the opportunity to figure out where are their pools of green assets or social assets, sustainable assets, we'll call them, and how can we bring to market new sustainable issuances or sustainable securitizations. Then on the private side, and I think this is where there's a lot of scope for innovation and thinking through how can we bring sustainability elements into deal structures for a lot of what I guess I called more of the vanilla asset-based finance type of deals. And so, thinking creatively about how can we make this deal more sustainable? How can we make it more green, for example? I've been doing a lot of work in that space, and I think it's just a very exciting area that I would like to continue focusing on. Now, on the data side of it, again, I think the arranging banks are playing a really important role in innovating and bringing more transparency to the market. And I'll give a major shout out to Credit Agricole in this space, who I've been working pretty closely with as they've been developing a methodology for avoided emissions for different types of securitizations. And what I've found through this type of engagement is that what I can bring to the table is, I can convey to them what's the type of information, the outputs, the data that I need to satisfy the preferences or to meet the demands of my clients. And in this case, it's really how do I help my clients incorporate their securitized products portfolios into their broader net zero strategies. And what Credit Agricole is able to bring, because they talk to so many issuers, they can bring their expertise and knowledge around what data is available, what can issuers collect, what's possible, and then build that into a comprehensive methodology that can be broadly applied across the market. And together we can create something that is really useful for the market. And so by having this type of collaboration and engagement, not only can I satisfy the sort of the needs of my clients, not only can I create something that's important for my clients, but we can bring broader transparency and broader innovation to the market. So I'm excited about this type of engagement. As Malea was saying, I think for engagement to be successful, you need to do it across the entire, I guess, value chain here, from issuers to asset owners and everything in between.
That's lovely. Thank you. So before you go and before we wrap up, we always ask our guests a final question. Our podcast is called The Responsibility of Investing. If there was one thing that you want our listeners to take away from the conversation, what is it?
I would say that responsible and sustainable investing in securitized credit is absolutely possible. We do it across multiple portfolios, return targets, really without sacrificing returns. But there's no off-the-shelf solution to do this. It really does take effort. It takes engagement. It takes creativity. It takes additionality. I would also say that it takes intentionality and transparency as well. Those are two things that I'm shocked that I got through this whole podcast not saying until the very end. But, ultimately, I think this effort really looks like getting access to better data, better outcomes for responsible investing in this market, and ultimately providing solutions for our clients that's still driven by long-term risk-adjusted returns.
I have hard to follow up on that, but kind of echo the same points here, which is that the securitized market is one where we can generate impact and we can do things like invest for net zero and invest for sustainable outcomes. And so, as asset owners and as other market participants are thinking about where can we innovate in this space, where can we move forward in this space, we should be focused on structured credit. We should be focused on this both in the public, the broadly syndicated space, but also in the private space.
It's wonderful. I feel like it's been a privilege to talk to you both because you're not just experts, but you're true enthusiasts, which is always a joy. And so to wrap up, if you've enjoyed today's episode and are interested in finding out more, please do take a look at the links in the show notes where you can find our technical guide on responsible investment in securitized debt, which was heavily contributed to by both David and Malea. Thank you so much again for sharing your insights and your practical experience. It's been a joy to speak to you today.
Thanks, Kate.
Thank you so much.
Thank you.